Hi, I'm Ken Mann, the Senior Managing Director at Heritage Equity Partners. Thanks for joining our video series. Here we'll endeavor to do short interviews with industry experts to tease out information on topics that should be of interest to you. Each interview will be very brief, but will be filled with nuggets of useful information to you. If you feel that you need to take a deeper dive on today's topic, please contact me at the email address below or phone number below, and I'll connect you with today's industry expert. Thanks very much, and I hope you enjoy today's interview. With me today for a discussion about the distressed lending environment and the asset-based lending environment is a seasoned veteran of that space, Mr. Jerry Jansen. Mr. Jansen is a principal at Ares Commercial Finance, a non-regulated asset-based lender. Prior to joining Ares in 2016, Jerry spent 30 years in the industry originating and structuring asset-based loans for the likes of Foothill Capital, Wells Fargo Capital Finance, and GE Capital. Whenever I'm in Atlanta, I try to sit down with Jerry and make sure that I have a good handle on what's going on in the distressed lending space. Jerry, thanks so much for being with us today.
It's great to be here.
I appreciate you sharing your expertise with us. What in general is the market right now for financing companies with losses and who may need debtor-in-possession financing?
Well, with the current bank regulatory environment, the regulated banks are not financing turnarounds. The financing is being done by non-bank finance companies.
Okay. Companies like Ares.
Yes, Ares. Ares is one of those.
Versus Bank of America.
Or Wells Fargo or
Right.
Regions Bank.
Okay. Are there certain size thresholds today below which it's just going to be impossible to get DIP financing, debtor-in-possession financing, or a line of credit for a somewhat distressed company?
Well, I would say if it's anything under $5 million is fairly hard to finance. And it's hard to do a DIP loan for somebody that's under 5. They just don't have the liquidity to pay all the expenses that go along with the DIP financing. So, but to the extent the company needs more than $5 million, there is an active market and there is non-bank capital available for that.
Are those thresholds similar in the non-bankruptcy environment, meaning similar dollar values?
Well, the market is sort of tiered out. There is lenders that specialize in that under 5. A lot of factoring companies go after that market. You get over 5, then you start getting some both regulated and unregulated asset-based lenders. But like I say, under 5 is very hard, and it's usually pretty expensive.
Okay. Speaking of expensive, how much more would you expect a distressed company to pay, for example, on their line of credit, than a healthy company in today's market?
Yeah, if you look at traditional bank financing, it's in that 3, 4, maybe 5% all-in pricing. And you get out of the bank and into the non-regulated guys, and you're probably talking 7, 8, 9, even some of the guys go over 10.
Okay.
And so there is a big gap in pricing between what healthy companies can get at a bank versus what turnarounds can get, not at the banks.
Which I guess you would expect, right? It's all about risk and reward.
Yes. Well, and most of the companies like Ares have lines of credit from the traditional banks.
Yeah.
And so you figure they're lending to us at a lower rate, and we're having to mark that up to re-lend it.
Right. Understood. Okay. So if you can describe for me, what would the typical terms look like in an asset-based loan, let's say, for example, for a $50 million a year manufacturing company?
Well, we would start with the accounts receivable, and you can typically get an 85% advance rate on receivables, but there's usually some things in the receivables base we won't lend on, so you should really count on an effective advance rate of right around 75%. Okay. Then next is inventory. We would get the inventory appraised, and we typically lend sort of 80 to 85% of net orderly liquidation value. That typically is somewhere 45 to 60% of book value.
Understood.
Then when we look at equipment, we would also have the equipment appraised. We lend off of a net orderly liquidation value. And you can typically get somewhere between 65 and maybe 80% of the net orderly liquidation value. And then real estate is probably the hardest to finance. It's the most illiquid asset companies have. And you can typically borrow somewhere 40 to 50% of fair market value.
Do you find that borrowers usually trying to get all of those assets packaged up into one loan, or do they often have to seek a different lender for the real estate, for example?
A lot of times we see the real estate separated out to another lender.
Okay.
And sometimes, the lender that's doing the receivables and inventory will know a real estate lender and parcel that off.
Sure. So what out there in the marketplace are things that you bump into that are deal killers? If this exists, you are not going to get financed. And I don't mean just by you or your group, but in general.
So I think to get a deal done, there's certain things that lenders expect. They expect that you hire a turnaround consultant, that you got somebody in there that's helping figure out how to cut costs and get the business back on track. They expect at some point to get the appraisals so that you can see, and I would say that there's a couple deal killers. Not having enough liquidity to fund a turnaround. So by liquidity, I mean that you apply the formulas to the assets, and that amount of money minus the loan is your liquidity. And if that's not very, if it's a too small amount, your deal doesn't get done.
Right.
So that's certainly a deal killer. And I think that there's certain industries today, oil and gas is a very difficult industry. That's sort of the deal killers that I see.
Yeah. Are there lenders out there where the cash flow doesn't exist, maybe the ratios don't work for a traditional, I shouldn't even say traditional, for any of the asset-based lenders, but lenders that might lend, for example, without underwriting against machinery and equipment or against real estate, even if the numbers don't seem to work from a cash flow perspective?
Yes, there are lenders that basically have appraisers, so they know what they can sell this stuff for. And a lot of times they will do a sale leaseback so that the asset doesn't get trapped in a bankruptcy. A lot easier if the deal doesn't work, if you own the asset and you loan on it, it's easier, to sell that.
So the lender would take possession of the machinery and equipment and lease it.
So in essence, they become a leasing company. They buy the asset from the company, lease it back to them.
Right.
And again, so if the company fails, they don't have to go through a foreclosure process. They already own the asset.
Yep. Okay. Good. Well, Jerry, we appreciate you taking the time to share your deep industry knowledge. Is there an easy way that people can reach you if they want to learn more about the opportunities?
Yes, you can go to the Aries webpage, and I have my contact information is on there.
Great. Thanks for being with us.
Thank you.
Take care. I hope you enjoyed today's interview and were able to come away with at least one very useful piece of information. Please keep your eye out for emails from us announcing future guests and other topics of interest. Please feel free to reach out to me if I can be of any assistance at the email or phone number on the screen, as well as if you have a topic that you'd like to hear about or want to make any suggestions for a guest expert. Thanks again.